If you ask a traditional banker how the financial system works, they will draw a map of middlemen, clearinghouses, brokers, custodians, and settlement layers. Every step takes a fee, requires permission, and operates on outdated ledgers that close on weekends. Decentralized finance, or DeFi, replaces that entire map with open-source code. In the early days, DeFi was largely treated as an unregulated casino. But in 2026, the narrative has fundamentally shifted. DeFi is no longer just an experiment. It is the permanent, high-speed, globally accessible backend for modern finance. If you want to operate in Web3, you have to understand how the core primitives of this system work, how they generate real yield, and where the hidden risks lie that wipe out beginners. The foundation: permissionless smart contracts. To understand DeFi, you must first forget how traditional banks work. In traditional finance, TradFi, trust is placed in institutions. In DeFi, trust is placed in cryptography and code. At its core, DeFi is a collection of smart contracts deployed on blockchains like Ethereum, Arbitrum, or Base. These contracts are essentially decentralized APIs. They hold funds and execute financial logic, trading, lending, borrowing, automatically. There are no compliance officers, no account minimums, and no business hours. If you have a Web3 wallet and an internet connection, you have the exact same access to a billion-dollar liquidity pool as a Wall Street hedge fund. But how do these platforms actually function without human market makers or loan officers? They rely on three core pillars: decentralized exchanges, money markets, and real-world assets. Pillar 1. Decentralized exchanges, DEXs, and AMMs. In traditional markets, trading relies on an order book. Buyers bid, sellers ask, and a centralized exchange matches them. This requires high-frequency market makers to provide liquidity. DeFi invented a completely different model: the automated market maker, AMM. When you trade on a modern DEX like Uniswap, you are not trading against another person. You are trading against a smart contract that holds a pool of two tokens. For example, ETH and USDC. Where do these tokens come from? Regular users, known as liquidity providers, LPs, deposit their assets into this pool. In exchange for letting the protocol use their capital, the LPs earn a percentage of every trading fee generated by the pool. The AMM uses a mathematical formula to determine the price of the assets based on the ratio of tokens in the pool. If someone buys a massive amount of ETH from the pool, the supply of ETH in the pool drops, and the math automatically pushes the price of ETH up. In 2026, the standard is concentrated liquidity. LPs no longer just dump tokens into a pool. They specify exactly what price range their liquidity should be used for. This makes decentralized exchanges incredibly capital efficient, often outperforming the liquidity of centralized exchanges for major assets. Pillar 2. Decentralized lending and borrowing. If you want a loan from a bank, they check your credit score, your income, and your identity. Blockchains are pseudonymous. They don't know who you are, and there are no credit scores. To solve this, DeFi money markets like Aave or Spark rely entirely on over-collateralization. Think of it like an algorithmic pawn shop. If you want to borrow $1,000 worth of stablecoins, you must deposit $1, $500 worth of a volatile asset, like Ethereum, into the smart contract as collateral. The smart contract locks your ETH and issues the stablecoins. Why would anyone do this? Usually, for leverage or tax efficiency. You might need cash today, but you believe the price of ETH will go up over the next year. Instead of selling your ETH and triggering a taxable event, you borrow against it. However, because the collateral is volatile, the protocol must protect itself from bad debt. If the price of your deposited ETH drops and the value of your collateral gets too close to the value of your $1,000 loan, the smart contract triggers a, quote, liquidation. It automatically sells your ETH on the open market, pays back the lenders, and charges you a massive penalty fee. Lenders, on the other side, simply deposit their stablecoins into the protocol and earn a dynamic, floating interest rate paid by the borrowers. The entire system is governed by math, running autonomously 24/7. Pillar 3. Real-world assets, RWAs, and real yield. The biggest evolution in DeFi by 2026 is how it generates yield. In the 2021 bull market, protocols offered 1,000% APY by simply printing their own inflationary utility tokens and giving them to users. This was a Ponzi-nomics trap. When the new users stopped coming, the token price collapsed, and the yield vanished. Today, the market demands real yield. Real yield comes from actual economic activity, trading fees on DEXs, borrowing interest on money markets, and most importantly, real-world assets, RWAs. Protocols have successfully bridged traditional financial instruments onto the blockchain. Today, billions of dollars of DeFi collateral are backed by tokenized US Treasury bills. When you deposit USDC into a modern DeFi savings protocol, that stablecoin is often being routed to institutional custodians who buy short-term government bonds, tokenize the yield, and stream it back to your Web3 wallet on-chain. This integration means DeFi is no longer isolated from global macroeconomics. It has become a highly efficient distribution layer for traditional financial products. The infrastructure, where DeFi actually happens. If you tried to execute complex DeFi strategies on the Ethereum mainnet, the network gas fees would eat your entire portfolio. Ethereum has transitioned into a settlement layer for large institutions and whales. In 2026, 95% of retail DeFi happens on Layer 2 rollups like Arbitrum, Base, and Optimism. These networks bundle thousands of transactions together, compress them, and post the mathematical proof back to Ethereum. This gives you the ultimate cryptographic security of Ethereum, but with transaction fees that cost fractions of a cent. If a tutorial tells you to yield farm on Ethereum mainnet, it is dangerously outdated. The hidden risks, what they don't tell you. DeFi removes the middleman, but it also removes the safety net. If a traditional bank gets robbed, the government bails you out. If a smart contract gets exploited, your money is gone forever. Smart contract risk. The code is the law. If a developer makes a typo or leaves a logical loophole in the contract, hackers will find it and drain the protocol's liquidity pools. Even audited contracts are not 100% safe. Oracle manipulation. As we discussed in our smart contract guide, protocols rely on oracles to know the price of assets. If a hacker can temporarily manipulate the price feed of an oracle, they can trick lending protocols into giving them massive, unbacked loans, leaving regular users with the bad debt. Impermanent loss. If you provide liquidity to a DEX and the price of one asset skyrockets while the other stays flat, the AMM math will systematically sell your winning asset to balance the pool. You can easily end up with less total value than if you had simply held the tokens in your wallet. Conclusion: DeFi is a double-edged sword. It offers unprecedented transparency, immediate settlement, and access to yields previously reserved for hedge funds. But it demands radical personal responsibility. You are your own bank, your own risk manager, and your own compliance department. Never chase APY without understanding where the yield comes from. If you can't see the source of the yield,